check that you are on mute.
Governor Lujan Grisham. Commissioner Garcia Richard. Secretary Romero.
Present.
Treasurer Eichenberg.
Present.
Mr. Jennings. Mr. Lavender.
I'm here.
Mr. Rawson.
Present.
Mr. Messina. Mr. Tejas.
Here.
Ms. Allen. Mr. Bingaman.
Present.
Madam Chair, we have a quorum.
Great. Next, we will move to approval of our agenda, item 1B. Do we have a motion to approve the agenda?
It's Harold. So move.
Madam Chair, this is Blake.
Yes, Member Rawson?
I would like to insert an item under 1D following the approval of the minutes for a point of personal privilege.
Is there objection to addition of that item?
Nope.
All right, Andy, could you, with that, are you seconding the agenda, Member Rawson?
Yes, correct.
All right, so Andy, would you take a roll call vote on approval of the agenda?
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion unanimously passes.
Madam Chair, this is Mike Messina, and I'm on the call now. Thank you.
Great. Thank you.
Madam Chair, this is Tim Jennings. I'm on here too, so I would have voted yes too.
Thank you, Mr. Mayor.
Matt.
Thank you.
And this,
Yes.
Madam Chairman, this is John Ulrich. I'm on the call as well, and I would have voted yes as well.
Welcome. Thank you. Thank you. All right. So at this time, I would like to recognize Member Rawson for a point of personal privilege.
Thank you, Madam Chair. Members of the committee, I would like to disclose an item and ask our staff to review and to advise regarding the relationship as it pertains to our SIC policies and the perceived conflict of interest. This revolves around a transaction that the SIC entered into on our April 27th meeting of last year, 4/27/21, where we approved and I supported a motion for $100 billion investment in Strategic Values Partnership LLC. Now that total transaction was, they were looking for a target of a $4 billion raise, and so the state's investment would be about $2.5 million. The Strategic Values Situation Fund that we voted on is a part of Strategic Values Partners, which is an $18 billion assets under management. And they are affiliated with the SDCG Global. Anyway, long story. Subsequently to that transaction, to the state's transaction, that fund purchased a supplier that my company does business with. So it could create a perceived conflict of interest. Now, the state's investment is 2.5%, which is pretty minimal in terms of the fund level. And then the SIC does not make specific investments in terms of what companies that fund invest in. Now, that fund is going to invest in between 60 and 100 companies. So, and then of course, my company purchases on a large national corporation like this is pretty insignificant as well. So what I would like the minutes to reflect that I'm asking for some guidance from the council staff, and for the purposes of benchmarking, I would also like to know regarding that transaction, when the transaction was initiated or the discussion was initiated by Strategic Value Partners, when they entered into a purchase agreement, when that purchase agreement was finalized, and what the transaction value is. Now, the company that they purchased, I guess I need to mention that, is a company by the name of Associated Materials out of Ohio, Associated Materials LLC. So if the minutes would reflect that request and if staff could pursue that, I don't know if we'll ever have an opportunity to vote on this matter again, but it would be instructive for me. I appreciate the council's indulgence.
So, Member Rawson, we appreciate that disclosure, and I don't know if we've got our general counsel on at this time.
This is Evan, I'm here, and we'll have to look into it.
Yeah, and Evan can call me directly if he wishes. And that's all I had, Madam Chair.
Thank you, Member Rawson. Next, we'll go to approval of our May minutes of our May meeting.
This is Harold, I move approval.
Do we have a second?
Second, John.
Okay, we have a motion for approval and a second. Any discussion on that motion? Hearing none, we will go to Andy for a roll call vote.
Commissioner Garcia Richards.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen. Mr. Bingaman.
Yes.
Madam Chair, the motion unanimously passes.
Thank you, Andy. With that, we will go to agenda item 2A, and it's my understanding our state investment officer is not present. So Andy, you will be covering some of the items. Can we begin with you?
Thank you, Madam Chair. Mr. Moise gave me the following information from his FIO briefing to share with the council. At yesterday's close, the net asset value was $34.42 billion. Distributions for the last 12 months, as of May, totaled $1,147 million. In May, we had record contributions from the State Land Office totaling close to $201 million. Thank you, Commissioner. We look forward to seeing the June numbers. On Friday, West Texas Intermediate closed at $107.62. New Mexico Intermediate closed at $104.17. Both were priced close to $70 per barrel a year ago. On Friday, the U.S. rig count was 907. It was 596 this time last year. The New Mexico rig count on Friday was 111, 75 a year ago. U.S. natural gas closed Friday at $6.17 per 1,000 cubic feet. It was priced at $3.62 a year ago. Thank you, Madam Chair. That concludes my portion of the report. Charlie Woolman will update the council on client matters.
Great, thank you, Mr. Woolman.
Thank you, Madam Chair. I'll be brief. Updating you on client matters. The council is now facilitating long-term investment for 23 government client agencies. Those include cities, counties, and political subdivisions. Those entities today are investing $1.7 billion across 45 separate accounts and across 14 different investment pools. That includes U.S. and international stocks, fixed income strategies, and for our larger clients, private market assets. The council provides this as a low-cost, low-frills service where the SIC's size and institutional rates that it can command for management fees are leveraged to provide the same low costs for other New Mexico entities. Western New Mexico University is going to be investing about $6 million with the SIC next week, and the North Central Regional Transit District will be joining the investment pools in August. That'll raise our total client number to 25. We have had initial inquiries from New Mexico County, a large New Mexico city, and others. Some of those inquiries have come due in part due to recommendations and discussions that council members have had around the state. So thank you for continuing to help educate New Mexico about this little-known resource. Madam Chair, that's the end of my comments.
Before we go on, are there any questions for Mr. Woolman on client matters or from Ms. Dundee? And we appreciate you all filling in.
Madam Chairman, this is Kathy Allen. I'm on the call now.
Great. Thank you, Member Allen. Thank you for joining us. All right. Hearing no further questions, we're going to go to agenda item 2B and turn it over to our Chief Investment Officer, Mr. Smith.
Well, thanks, Madam Chair. Good morning, everybody. Lots going on out in the world. I'm sure you're keeping track of on a daily basis. First, on the agenda, we've got an active agenda for you today. Lots of performance reports in there. Your quarterlies are in there for the private asset classes, plus your broad April report for the broad portfolio. So we'll walk you through those. The consultants will and make some both performance and market commentary. On the macro side, there's just tons happening out there. Inflation and subcomponents like gas and food prices are the most talked about factors. Treasury Secretary Janet Yellen joined a chorus of voices indicating higher inflation would persist. This after steadfastly proclaiming that inflation would be transitory when prices first took off earlier this year. So hope she's wrong again, and we don't get the persistent inflation, but it's starting to look like it. The Fed raised rate 75 basis points at its last meeting. Probably, many economists are handicapped maybe another 150 or so to go on the Fed funds rate, and an awful long way to go on reducing the balance sheet. So still more monetary tightening and hopefully some fiscal tightening to go. That's what's been pressing the markets down as people readjust and think through where interest rates could be, 6 months or a year from now. 10-year Treasuries also moved higher. It's now in the 3 to 3.5% range. Most mainstream economists are dropping their growth forecasts here in the U.S. and globally. The World Bank made a big cut to the global growth forecasts this month. Not many are calling for a recession until the back end of 2023. We still think they're a little behind and are to be coming this direction for first half of 2023. I think what's holding many back is the labor force here, at least in the U.S., remains very tight with 3.6% unemployment, and wages are starting to move higher. People are also spending, and we're seeing a drop in the savings rate to quite low levels, and credit card balances are starting to rise. So, but I think there's still good strength in terms of labor and spending, and I think that's what's holding many economists back from moving forward their recession forecast. So keeping an eye there for sure. In terms of markets, Marcia Matias, as well as the specialty consultants, will have some market commentary for you. So I'll be brief. We've seen the U.S. stock market drop into bear market territory this month. And at the same time, the bond market has sold off with the benchmark 10 years. We mentioned hitting 3.25%. It's unusual that both stocks and bonds sell off at the same time, and it's left traditional 60-40 or 70-30 portfolios with significant losses here in the near term. However, the S&P has corrected about 2/3 of the run-up from the highs pre-COVID, and earnings over that same time frame are up about 40%. So there's been some multiple compression. Stocks are a little cheaper, still relative to history, quite expensive, and we expect some more multiple compression as interest rates rise. On the operations side, we're in the search. We're continuing our search for 3 new folks. We just got approved a search for an investment strategist, so that's the third. So still looking for a fixed income analyst, still looking for a real estate and real return analyst, and then a new search for an investment strategist. That'll get the team, after those hires, that'll get the team quite close to our complement of 12. And I'm much happier than I was just a few months ago reporting to you that we had several losses and the team was down quite low in numbers. I think that's it, Madam Chair. I can take any questions on the macro side or markets, and I'll just turn back to you.
All right, thank you so much, Mr. Smith. Any questions? All right, hearing none, we're going to turn it over to RBK for our April 2022 performance report.
Okay, thank you, Madam Chair, and good morning, everyone. Thanks also to Vince for his comments on the markets. I'll try not to be too repetitive here. We do have the April flash report for your review. You will recall that at the time of the last SIC meeting, we reviewed the full executive summary. So a little bit of a briefer update today, and we'll also try to make some comments that brings the market closer to date, since there has been quite a bit of activity. As usual, I'll provide an overview of the capital market environment, and then Marcia's going to dig into the performance results that you'll see here as part of the April update. I think as part of this, we can start on page 21 of the meeting materials. That is a page that you're familiar with and provides a high-level overview of the capital markets. You can see again the market performance in the bottom right table that shows the various trailing time periods, including months and quarter to date, calendar year to date, so on and so forth. You'll find the equities are clustered at the top. We have capital preservation in the middle, so that's generally your bond markets, your cash, although, again, as Vince alluded to, the bond market has not been kind to investors this year, given what's happened to interest rates. And then the diversifiers, generally those that are not your traditional assets at the bottom, and they also tend to have better linkage to inflation. I think, again, the first thing you'll notice, similar to the end of March, a lot of negative numbers. So many of the losses that we saw at the end of the first quarter have extended into April and have actually continued to varying degrees. The month of May, again, I know we're not covering that specifically today, but I just wanted to provide you that information, was quite volatile. Again, although on balance was much more muted, relatively flat by the end of the month. But then again, June has experienced further drawdowns and has led to year-to-date returns for most of the equity markets to approach or even cross into bear market territory. So we're seeing most of the publicly traded equity indices down anywhere from 15 to 20%, clustered relatively tightly. Interest rates across the yield curve, and you can see that in the top right chart, continued to rise. Generally, you can compare the blue line to the green line to show you the month-over-month change and how it's developed over longer time periods as well. And that continued increase in rates that we've experienced for the past 6+ months now has led to some losses in the aggregate bond index of the bond market that are now closer to 11% compared to that 9.5% that's listed at the end of April. So we saw another 1.5% or so. By comparison, though, your exposure to the non-core fixed income market is actually modestly positive and for that exact same time period. So that different emphasis, that different focus between your core and your non-core fixed income portfolios is working as intended, and as we've said in the past, has been a thoughtful refinement to your approach to the broader fixed income bucket. I think Vince already mentioned that the Fed earlier this month raised the benchmark interest rate 75 bips. That had increased from 50 to 75. It was at least originally contemplated, and frankly represented one of the largest increases that we've seen in the past 2 decades or so. Most of that came from the May inflation report that, again, was higher than the prior month. So I think the pressures on inflation are certainly here. And we haven't heard the word transitory used in quite some time, and probably won't. At this point, it's a matter of just how persistent and how prevalent it will be in some of the stickier parts of the market. And the Fed may very well hike a similar amount in July, so there's additional hikes anticipated. So with all that, there have been very few places, I would say, to hide from this market repricing that's happened, particularly in the publicly traded space this year. The private markets and real assets in particular, given their more direct linkage to inflation and also their higher focus on income, you recall that's always been a focus over the last, 5 years or so now, have arguably performed best and likely will continue to be quite resilient as we move through this type of market environment. Volatility also will likely remain elevated as we move through some of these uncertain events that are still ahead of us. And the Fed, of course, tries to figure out how to balance, I won't say soft landing, but maybe softer landing or not a complete crash, but find a way to rein in inflation without tipping us into a full-blown recession. I think that's going to be a lot more difficult than maybe anticipated. So we'll see how successful they are with that. I'll stop, see if there's any questions. Happy to address those. Otherwise, we'll turn it over to Marcia for comments related to the performance.
Marcia?
Thank you, Madam Chair, and thank you, Matthias. Good to turn off mute, I guess. I'm going to take you to page 23 and look at performance. And as we do this, just a reminder, this is an April flash. And what does that mean? Well, it means that performance for real return, real estate, and private equity is held at 0% in the inter-quarter month. So this is a preliminary number and does not include updates for your private investments. With that said, on page 23, Matthias referenced negative returns, and as he also mentioned, that continues through yesterday. For April, preliminary numbers are down 3.77 for the total fund. You see the numbers down below. Land grant was slightly below that with the severance tax for the month. A calendar year to date, a little bit different story. For the land grant, fiscal year to date through April, you were positive. Sure, that number has changed into negative territory as Matthias went through the updated performance for May and so far in June. So again, month April was down 3.77 for the total fund, 3.9 for land grant, 3.87 for the severance tax. Now I'm going to take you, if you look at the following couple pages on 24 and 25, you can see the asset allocation for each of the funds. Still the same story that we've talked about, underweight to the some of the more private portions of the portfolio. The market has taken care of some of that and reduced it. So again, having some difficulty keeping up with deploying the cash to keep at your target allocation. You do, as you know, have cash in that portfolio. Again, it's a good problem to have, but receiving so much cash from the land commissioner's office, it's hard to get that money deployed. And you can see that on the those two pages, pointing out some of your allocations. You'll note the difference in returns. Some of your allocations have far less equity exposure And they obviously are doing better than the land grant and the severance. I'm going to take you now to page 29 in your diligence and look at the composite performance. Again, you see the land grant and severance returns up top. Down below your U.S. equity composite. You'll notice if you compare U.S. equity and non-U.S. equity for the month and for calendar year to date, that actually non-U.S. portfolio is performing better than the U.S. portfolio, something the long time coming in the U.S. when the market is going up, the U.S. composite is doing far better than on an absolute basis than the non-U.S. Underperformance for both public equity composites, more so shorter term, the U.S. composite is doing much better, but still trailing slightly. And longer term, non-U.S. has outperformance, but trailing in the short term. As Matthias mentioned, your core fixed income has also been negative. You can see from your core composite that the benchmark was down 3.79 for the month, down calendar year to date, down 9.5. You've done better. Your core fixed income composite has done better. You have diversification within that portfolio. You have some shorter duration that's been additive. So you are doing much better than your benchmark. Also, to add what Matthias said in numbers, diversifying into non-core fixed income has also been a good move, additive to the portfolio. Compare the returns for each, the non-core composite to the core, and non-core composite has held up in this market environment much better and actually on a relative basis outperforming its benchmark. We talked about cash. You can see the cash return there. And then if you go to the next page, on page 30, this is where we can show you that we're holding in these intra-quarter months, we're holding the private assets at zero. And since those are, we have performance for those on a quarterly basis. And the only public exposure here is with your financial return. That's a real return, and that's a very small piece. Part of that, the bigger hunk of that is your MLPs. I want to point out on page 31, this is attribution of your return for the month. And the point I want to make here is, as we always say, and as we always know, that your return is mostly due to your asset allocation. Your investment pool performance or total fund performance was down 3.91 for the month. Most of that can be attributed to your strategic asset allocation, which was down 3.64. If you go to the bottom left-hand side, you can see how that translates. The biggest drivers for the negative return were your two public equity portfolios, U.S. and non-U.S., driving most of that negative performance. For the month, you also had some manager underperformance, but that was very small. And I want to compare that. If you go to the next page and look at the 1 year, this is attribution for 1 year preliminary through April. Again, the same story, although at this point, net positive return. So the investment pool performance was up 4.12. Your strategic allocation did better than that, 5.15. I want to point out on that bottom left-hand side, you can see the negative exposure there. But here you can see the effect of not being able to deploy into those low return real estate and private equity up to the target. So those asset classes perform better. If you look to the next column over, which says TAA, tactical asset allocation, you see that was significant negative attribution to that because you weren't in those asset classes, but to your target, and those asset classes did much better. And for the year, you actually had manager outperformance. So with that, just again, preliminary return. Those are the only things that I wanted to mention. We can take any questions, but April was a difficult month and May will be the same. And through the second quarter, I will remind you, however, I said it was done, but remember though, when we looked at the executive summary for the period ended March, again, asset allocation is the biggest driver of return. We're seeing negative numbers here, but you have done in this difficult market environment, you have done better than many of your peers. In each of the three universes we looked at for the end of the quarter, you ranked in the top decile usually. I mean, for the universe that you look at most, you ranked in the third for that quarter. And the median plan in that universe was down 3.59. You were down 1.33. So the point of saying that is your allocation, your diversification has served you well in very difficult markets, and we expect that to be the same going into the second calendar quarter. Madam Chair, that's what if any questions.
Great, thank you so much, Marcia. Going to questions from committee. Any questions on the April flash? Okay, hearing none, we will move on to our quarterly PMRs. We're going to start with our national private equity program, and we'll turn it over to Mr. Lee.
Thank you, Madam Chair. This is David Lee. These materials start for the national program on diligent page 48. I'll turn it over to Richard Pugmire Mercer to go through his comments regarding this fourth quarter 2021 performance, and he will likely start on diligent page 51. Go ahead, Richard.
Thanks, David. Thanks, Madam Chair. We're covering Q4 2021 performance today. Just as a reminder of private equity reporting timelines, it does take longer to put together the Q4 performance because the funds receive an external annual audit. So it usually more than doubles the time that funds have to send the reports. The performance numbers we're talking about today are based on audited financials from the funds. And I know it's also challenging to report on Q4 when so much has happened in financial markets and the world since December 31st. So I'll try to give some insights into where we see things going as we move through the report. As far as the Q4 headline goes, we saw another strong quarter of performance in the national program, which now goes back to a trend that started with the Q2 2020 performance report. So basically a year and a half of strong performance reports. The quarterly return generated a gain of approximately $241 million, which wasn't as large as last quarter's gain of $275 million, or the quarter before that, which was over $400 million. But $241 million is still a large quarterly gain compared to what we've seen historically in the program. This first slide shows an overview of performance and activity in the program. The horizon returns show the strength of the recent performance. The one-year return is 44%, and the three-year return is 25%. From a since inception standpoint, the 2011 and after funds have generated a 20% return, and the program's overall net IRR is a 13.3% return since inception. This equates to an over $4 billion gain since the inception of the national program. We've also had as you know, from an activity front, a busy start to the year in 2022 with $247 billion already approved. And the fundraising market has had a lot of strong managers come out to the market, and we've been taking advantage of getting access to some high quality new names, in addition to doing the high quality re-ups in the portfolio. And today we actually have two high quality re-ups you'll be reviewing with TDR Capital and Scale Venture Partners. If you go to the next page, page 52 on Diligent, this is our typical summary of the numbers in the portfolio, and I'll just highlight a few on this page. The net asset value increased by $105 million, which continued the trend of net asset value increases going back a year and a half. One of the interesting things about this period we're in is the performance increases have been accompanied by realizations or distributions coming back to the SIC. So the net asset value increase is actually not as large as the performance gain because it's offset by the distributions coming back to the SIC. Year over year, this table shows the impact on both the net multiple and net IRR has been positive, with the net multiple increasing to a 1.66 times return from a 1.5 times, and the since inception net IRR increasing to about 13.2% from 12%. When you look at the sub-strategies, buyout and growth continue to be the strong performers, with both strategies almost at a 15% or higher net IRR in the active funds, and both being above a 1.7 times net multiple. And the graph below really shows how the last year in particular has been a big contributor to the increase in performance, with the 10-year return increasing to 15.2% for all funds. The next slide goes into more detail on the net asset value changes over the last 2 quarters. All strategies contributed to the gain in Q4, but remember with the national program, there is a small venture capital allocation right now as we've started building that up over the last few years, and that's going to take time to really contribute to returns in a meaningful way. The gains were also widespread, with 72 funds reporting net gains. And as you can see in that graph below, the large amount of distributions, which were over $300 million in Q4, offset some of the net asset value increases that would come from the contributions and the portfolio gains. I mentioned when we did the Q3 performance that we did end up getting over $1 billion of distributions in 2021. I mean, to show how remarkable that number is, the year-end 2020 net asset value for the national program was $3.1 billion. So the portfolio had a large cash yield in 2021 of almost a third of the starting net asset value. It's worth mentioning that there's also about $500 million of contributions in 2021 that were made to the funds. So far in 2022, through the end of May, we've had about $180 million of contributions and $188 million of distributions. So both are tracking lower in 2021, with distributions being much lower, which isn't surprising given the market volatility that we've seen. Turning to page 54, this goes into more detail on the top contributions, distributions, and the gains and losses in the portfolio. We continue to see strong gains across multiple funds. 7 funds had gains over 10 million, and there wasn't really any offsets from large losses. Only 2 funds really had losses more than $1 million. And the largest one there, TDR Capital 4, which we're reviewing today, that was really driven by currency, as the portfolio company values actually increased in Q4, but this fund is denominated in euros, and we report performance in dollars. So the weakness in the euro contributed to that slight loss. For quarter 1, we're still in the process of getting all the performance report, but it looks like performance may come in with a slight gain, which is essentially flat, which will be different from the last 6 quarters that we saw. We're also seeing much more variability in the fund returns than the reports in the recent past. Some funds will have losses, which are driven by mark-to-markets of their publicly traded holdings. But we are seeing some increases in fund valuations too, due to some of the private company valuations, because managers are still reporting strong performance in a lot of portfolio companies. Historically, though, private equity managers have been slower to write up their portfolios when markets are rising, and we saw this over 2021 when a lot of the companies that were sold at higher valuations. But they've also been slow to decrease valuations when markets decline. And so with this lag and the continued weakness in the public markets, we may see more downward adjustments in Q2. The next slide 55, shows a bi-vintage year look at the portfolio's performance against the Burgess Private Markets benchmark. Since 2011, performance has been above median in all years except 2013, which has really been the same story for multiple quarters now. This is what the goal is, given we're seeking to build a diversified portfolio. And absolute performance has been strong across multiple vintage years in 2011 and after, with every year generating a 13% or greater return. The next slide shows a different type of benchmarking where we compare it against the public market benchmarks over the last 10 years by calculating an IRR using the cash flows from the portfolio and the index values. The MSCI ACWI benchmark covers multiple countries and geographies, including the US, Europe, and Asia. which is similar to our focus in the national program. So that most closely focuses what we're trying to do in the national program. And the national program has outperformed that benchmark by 4%. But public equity markets have been strong in the US, and the national program is under the Russell 3000 by about 2%. And it's slightly above the Russell 2000, which focuses more on the smaller companies in the Russell 3000. And then finally, I'll end on the summary slide on page 57, which really summarizes the state of various strategy components in the national program. We have a 300 million to 400 million annual pace. We had 410 million closed in 2021, and we're at about 247 million through May 2022. The sub-strategies and geographies are all within target. There's no general partner exposure above 10%, although there's two above 9%, but the overall performance of those managers is at an 18% and 24% net IR, so they've been strong contributors to this performance in the portfolio that we've seen. On the fund series, there are 5 fund series above 5%, with performance ranging from 17% to 41%. And our new manager count is at 31 since 2011, as we have added some new managers in 2022, and we're seeking new relationships in 22 of some hard to access fund managers, which you've reviewed in prior meetings. With that, I'll conclude my remarks, and I'm happy to answer any questions that the council may have about the national program performance.
Great, thank you to Mr. Pugmire and Mr. Lee. Any questions on the national program?
Madam Chair, this is Tim.
Yes, Mr. Treasurer.
Thank you. Hey, on page 56, the difference between the Russell 3000 and the State Investment Council, I listened to your comparisons of all three of the graphs, but is that 2%, is that fee load? What do you contribute that to?
No, it's really attributed to the large cap companies in the Russell 3000, which have, in particular, large cap technology, which has been a strong performer. When we're calculating the public market equivalent, we actually use any cash flows for management fees in that calculation as well. So, let's say a fund calls $1 million for management fees. This calculation will assume that $1 million gets invested in the ACWI or the Russell 3000 or the Russell 2000. So management fees are considered in the calculation.
Okay, thank you. Thank you, Madam Chair.
Yeah, this is David. Mr. Treasurer, just to follow up on the answer, I think it was really just an outperformance of large cap, and particularly large cap, during this 10-year period. And just a reminder for some of the newer council members, this is a public market equivalent performance, so this is not just a 10-year time-weighted performance. Public market equivalent performance is a little more accurate because the private markets and our private equity portfolio, it only draws cash at certain times and distributes cash at certain times. So what the public market equivalent performance does is it invests in the benchmark when the manager calls capital, and then it sells it when it distributes. So these numbers, just for clarity's sake, will look very different than a 10-year return for ACWI, Russell 3000, Russell 2000 that you'll see on the RBK page, because it doesn't encompass the whole 12 months per year and 120 months for the 10 years.
Great, thank you for that. Further questions before we move to our state program? All right, hearing
Madam Chair, this is Madam Chair John Bingaman.
Yes, Member Bingaman.
It's just an observation to the treasurer's comment. I mean, I would just direct people's attention to page 51 of Diligent that sort of shows the breakdown of returns of the portfolio for the funds that were selected in 2009 and before, as opposed to ones that the current council and staff has selected in 2011 and after. And there's really a dramatic, difference in the performance of those two portions of the portfolio. And so I think the overall return, that 15%, which you can see there at the bottom, is comprised of about 8.7% from the 2009 and below and 20% from the 2011 and after. So I think the overall return is really being dragged down by some decisions that were made, literally 15 years ago in terms of what funds to invest in. That, I think we should all just bear that in mind as well.
Good point. Thank you.
All right. Is there anything further on this? Thank you for that reminder, Member Bingaman. So next we're going to go to our Q4 report for the New Mexico Private Equity Program. And Mr. Lee, I don't know if you want to just turn it over to Mr. Cassidy at this time, Wilmer.
Yeah, we could do that. Let me just cite the pages. These materials start on page 69. We will probably just turn it over to Richard Pugmire again for comments on page 72, unless Chris has any introductory comments.
No, let's just move straight to Richard.
Okay, Mr. Pugmire.
Great, thank you, Madam Chair. Starting on page 72, similar to the national program, we'll start with a slide at the beginning to show the time horizon performance by the category of funds in the New Mexico program to give you a better sense of what is driving performance over different time horizons. The quarterly returns in Q4 will mix depending on the strategy. The co-investment funds and the older fund investments were down. But we had a strong quarter from the 2016 and after fund investments, and we'll show some details on a later slide to show what was driving that. When looking beyond the quarter, we have had positive contributions from the newer fund investments made in 2016 or after. And just as a reminder, that was when the legislature really removed that requirement to open an office in the state of New Mexico. So it really widened the universe of funds that could be chosen for the New Mexico program, and we were able to get more higher quality managers into the program. Since inception, these funds are at a 28% net IRR and a $64 million gain. But because these funds are all relatively new, the gains are relatively largely unrealized at this stage. And we haven't seen the sizable realizations in the New Mexico program because a lot of these investments are newer. So there could be volatility in these numbers going forward with what's going on in the broader market. The co-investment funds have also had a sizable influence on both the near-term and the since inception performance due to their longer history and the large size of exposure to the co-investment funds. And you can see over the last year, the co-investment funds are down over 5%, and they have a since inception net IRR of 0.6%, which contributes to a gain of almost $16 million. From a commitment activity perspective, we have done 2 commitments so far in 2022 for $15 million total. And we do have a pipeline of new and re-up fund opportunities that we continue to evaluate for 2022 and expect to make more commitments this year. Turning to the next page, this is that summary slide similar to the national program, page 73. The overall net asset value decreased slightly by $10 million, but it was really driven by distributions that were received in the quarter, which is a good reason to see a net asset value decline. The since inception net IRR has increased year over year from a 1.1% to a 1.5%, which was again driven by that newer fund commitments that we previously spoke about, and also the positive performance of the recovery fund. And you can see on this page the year-over-year change in fund investments. It goes from a 2.4% net IRR to a 4.1% for the active funds on a year-over-year basis. Turning to the next page, which breaks down the net asset value changes, in Q3, we actually had a portfolio loss, which drove the net asset value decline in that quarter. But in Q4, we had a gain of about $5 million, but the distributions were $15 million greater than the contributions, which contributed to that net asset value decline. And really what's happening with the cash flows, we had a good Q4 on distributions in the New Mexico program that were driven by the recovery fund, which in addition to the interest payments that have been received, there's been a number of loan repayments as well. And so we for the year, with 17 million being received so 2021 distributions were at about 29 million total, and that compares to 55 million in 2021. And to give you a sense of how 2022 is tracking through May, distributions have also exceeded contributions by about $10 million so far, as we've continued to get some distributions from the recovery fund. The next page, page 75, to go into more detail on the quarterly activity, you can see there in the lower left table that the top quarterly distributions, 3 of the top 5 distributions were from the recovery fund. The gains and losses on the right side are mixed, with the gains being more sizable this quarter as companies' valuations were increased overall. And this was primarily driven by companies raising capital at larger valuations that was coming through. The losses, on the other hand, were really driven by declines in publicly traded companies and the mark-to-market at year-end. That first fund listed there on the top reported net loss actually had an IPO at a higher value than the previous valuation, and it was the top reported net gain in the Q2 performance and really positively influenced that Q2 performance. But that stock price of the company has continually dropped in Q3 and Q4 and subsequent to Q4 as well with what's going on in the public markets. And so that was what was driving the loss. Same with the co-investment funds, where there's a sizable exposure to a publicly traded company that has traded down since Q3. So that's really kind of what's been driving the net losses so far. Turning to the next page, page 76, this slide shows the updated economic impact numbers. And over the last 2 years, we've really seen an increase in a lot of these numbers, driven mainly by the recovery fund, both the number of New Mexico-based companies and also the capital invested from the State Investment Council and the funds. The portfolio is now at 113 New Mexico-based companies, with 15 being funded over the last 12 months. The total invested from the State Investment Council is up to just over $378 million, and the fund level investment is at $496 million, with more than $69 million invested over the last year. These numbers haven't changed. There's 5 companies no longer located in New Mexico and 25 that have received New Mexico government incentives, and that did not change quarter over quarter. The next page has more detail on the economic impact from the program, page 77. And the job numbers is really where we've seen a strong impact from the recovery fund. A lot of the New Mexico program investments in the past have been venture capital backed companies. And, while there is a number of jobs at these companies, the more mature companies that the recovery fund has been investing in have had more jobs. And jobs have increased from 3,752 to over 4,000 in Q3, and it's now at 4,443, really driven because of those companies that are in the recovery fund. And job growth since inception has grown from just over 1,000 to now 1,876. And a lot of this job growth has come from specifically the hotel and leisure companies that are in the recovery fund. And, they've really picked up on their hiring through Q3 and Q4 as these companies kind of come out of the pandemic and anticipate further activity. There was also an increase in payroll numbers, and they were up 10 million from last quarter to a total of 198.8 million. And the expenditures on New Mexico goods and services also increased by 7 million to 216 million. We have some other slides following this that go into more detail on the portfolio composition in the New Mexico program, but I'll end there and happy to answer any questions from the State Investment Council.
Great. Questions on the New Mexico program? Okay, hearing none, we'll move to real estate. Mr. Sable.
Good morning, Madam Chairman. This is Keith Sable speaking. presentation begin on page 3 of Diligent. I'll just make a couple of quick introductory comments before handing off to Seth. Before I start, I would reiterate the comments that Richard made with respect to timing and reporting lags on 4-quarter performance. And so just recognize that the events that we're talking about today are largely quite a ways in the rearview mirror. Having said that, the 4th quarter for both real estate and real assets were strong performances. Real estate outperformed its benchmark by approximately 150 basis points and real assets by 80 basis points. There has been some carry through into the 1st quarter. The uptick in inflation has had a material impact on the performance of long-time laggards like the timber sector, and then geopolitical risk has certainly contributed to the increase in energy prices and provided a substantial tailwind to the MLP-related exposures. Well, I mentioned there has been some carry-through performance into the 1st quarter. The Q2 market environment has changed markedly from what we see in the rearview mirror, and so I would offer another cautionary comment that the usual caveat that past results are not indicative of future performance. With that, I'll hand off to Seth for his in detail analysis.
Thanks, Keith. This is Seth Marcus at Townsend. Good morning, everyone. So I'm also joined today. There's a couple additions from the Townsend team. Stephen Ernstein and Teddy Grzinski are both here to answer any questions that do come up. But to Keith's point, this is a real estate PMR performance measurement report dating back to year end. So I'll do best to sort of keep this brief, but also elaborate on results, through the first half of the year here. So as Keith mentioned, starting on page 93, this is a noteworthy report that when we think about take our minds back to where we were in the 4th quarter. That performance was exceedingly high throughout 2021. It was really a record year for real estate, and real estate generated a 28% net return for the year, outperforming the benchmark by over 700 basis points. Much of this overall return was driven by year-over-year rebound experience from the 2020 COVID year, as well as more specifically to outperformance within the New Mexico portfolio was really due to strong sector allocation. We've noted this in the past, with overweight to industrial, as well as alternative property types, as well as an underweight to office and retail. We're also working on increasing our multifamily exposure, which has performed well historically. The other note I'll make here that this year-end report is that we do provide fund summaries starting on page 117 of Diligent. There's a summary on every individual investment within the portfolio. We do this on an annual basis just to provide a bit more details on the underlying investments in the plan. I won't go through those, but just want to note it for your knowledge. The 4th quarter return, and I'm focused on slide 96, or page 96. The 4th quarter return of 9%, 9.2 to be exact, was the highest single quarterly return experienced by the SIC under the real estate portfolio. This just follows the quarter 3 of 2021, where the portfolio generated 8.4%, the highest return up until then. So to provide a bit of context, the typical expectation for core real estate is a 7 to 9% annual net return. And as noted, we see that here just in 1 quarter alone. To talk about where we are today, temper expectations maybe just a bit, and really consistent with what we've really been experiencing year to date is that the broader markets, we do expect softening of these returns this year, although still positive year to date, but expect more in line with that 7 to 9% historical performance. We have most of 1st quarter performance reported as of today. We're sitting at about 6%, so still a pretty high number. And our estimates for the 2nd quarter, although it hasn't officially ended yet, is in the 4% range. So both of these are definitely higher than anticipated. And really that's due to the valuation lag in private markets, and specifically in real estate, as we wait for appraisals and transactions to take place. The other note I mentioned about where we are today from a capital flow standpoint, in the 4th quarter of 2021, we put out about $264 million of contributions. That again was one of our largest quarters of capital being invested in the market. We also received back over $220 million of distributions. That was the single largest distribution we received in a quarter. And that was really a result of a couple different phenomenons. One of them being the manager that we'll talk about a little bit later, EQT Exeter, making a portfolio sale where really we're distributing a sizable amount of capital due to that lump sale. Lastly, on slide 96 still, we do show the full real estate performance in that first bar, as well as the new commitments since 2011. You'll see over the last 5 years, those returns are very close, really within 30 basis points, even over the 5-year period. As a legacy portfolio, really it's shrunk in size, and it's now just represents about 1.5% of our NAV. Where you do see the difference and where it does impact the performance in that long-term number, that those two since inception numbers, vary significantly due to that legacy portfolio. From an allocation perspective, at quarter end, our allocation was set at about 10.4% versus our 12% target. This was a 10% increase quarter over quarter as the growth of the real estate portfolio slightly outpaced that of the overall plan. Just to put some dollars behind that, and I mentioned this earlier, that was about a $211 million net increase in value quarter over quarter. This allocation is something we'll look very closely at in the coming quarters. We know the total plan number adjusts with equities, and our commitments that was approved over the last year, we're definitely starting to invest in call capital. That's something that'll change as we move through the year. And the other point I'd like to make on allocation is today we're sitting at about 66% of our exposure in core real estate, 34% in non-core. That's about 10% off of where we target. We sort of target a 55-45 split between those two. We are more than comfortable having an overweight to core today. Some of the prior presentations talked about the income generating off the real estate portfolio. That comes from those core assets that rent generated from owning and collecting rent from tenants. So that really does drive the core, comes from the core portfolio, where you'll see more appreciation and value creation out of the non-core. So we are comfortable with that way and well within our policy ranges. On slide 98, we show that we've made consumable commitments already this year. We'll cover this a little bit more when we talk about the potential commitment that we're going to present today. And then just moving on to 99, we note this in the past, and it's really important here that the portfolio continues to outperform, but at the same time reduce the overall fee load. So as New Mexico and Townsend continues to collaborate and take advantage of fee savings when accessible, this is really driven by Townsend's ability to aggregate client commitments, negotiate fee savings for all of our clients across our client base, really based on that weight of capital that is we advise on the market. So this number stood at about $2.4 million of annual fee savings as of the fourth quarter. This is from 9 different managers, 16 different individual investments. We see varying sizes on this page. Just to wrap it up, maybe the last slide I'll talk about is the PME, the private market equivalent. This was brought up earlier in the private equity discussion. This is on slide 107 of Diligent. You'll see here we show 2 different PMEs. One on the total portfolio since inception, you'll see just a very slight underperformance, about 10 basis points relative to the public markets. This is, again, taking into account the full history of the portfolio. When we look at just those new commitments made in 2011, we see that 330 basis points of outperformance due to that rebalancing that really was made by this committee. I'll stop here. There's a lot of clear information here, but happy to answer any questions.
Thank you, Mr. Marcus. Questions on the real estate Q4 report? Okay. Thank you very much for that. Yep, we can turn it over to Real Return.
Great. Thank you, Madam Chair. So I did my initial warm-up comments for Seth, so I'll step out of the way and Seth, you can just dive in.
Mr. Sable, remind us what page this begins on.
One moment.
This is on page 189.
Thank you very much.
Sure. So Seth again here. So here, again, we're talking about the real return portfolio, combines real assets as well as your MLPs and financial asset portfolio. The portfolio currently represents 8.8% of the total plan based on market value. The financial assets, the MLP portion of the portfolio, currently make up about 20% of the total real return, where the real assets are about 80%. So right on what our target is there, but slightly under the 10% target allocation at 8.8. Again, we did do fund summaries on these investments as well, starting on page 216 for your review. But overall performance noted on slide 193. Here, the first bar is the full real return portfolio. The second is just the real assets, so that excludes those financial assets and MLPs. You'll see during the quarter, in the 1 year period, that the portfolios outperformed the CPI 300. Similar to real estate, the 1 year return really does reflect a recovery after the 2020 vintage year. Over the 1 year period, both real return and real assets outperformed. Outperformance totaled 550 and 250 basis points respectively. But as a reminder, the significant difference between these two is that MLP position. So we referenced this in the past, but just to put some context around the volatility given the public market exposure in the energy sector, this position produced a 1 year net return of 41%. Yet over the full life of the investment, it remains relatively flat. So to highlight that volatility, we experienced in this position about a year before this, MLP portfolio 1 year 2020 was a negative 25% return, and 21 was at that positive 41. So there's the volatility in this performance. Moving along, I'll focus primarily on the real assets, where Townsend specializes and is your specialty consultant. So our current exposure for real assets is 8%. Based on the fourth quarter market values, real asset performance or portfolio is currently about 7.1% of total plan. And when we include unfundeds in that number, we're about 9.1%. So on target to be at our target allocation. On a percentage basis, this was relatively unchanged quarter over quarter. However, the portfolio did increase by $100 million during the quarter. That was just in line with the total plan growth. We do anticipate this allocation to increase as we have uncalled capital being deployed and new commitments. And the last thing I'll highlight there is that of the strong sort of 12.8% 1 year net return the real asset portfolio produced, each underlying sub portfolio positively contributed. So I'm jumping ahead a little bit to slide 198, showing sort of the contribution return over the past year. So consistent with past results, this 1 year performance was led by infrastructure as well. Those are the two largest components in your portfolio, so they will always be the drivers, either positive or negative. But infrastructure has been the leader in this portfolio over the last 5 years, and is where the really focus remains when we consider new investments going forward. To that point, infrastructure represents about 49% of the portfolio, or $1.1 billion on an NAV basis. Energy was the other major contributor at 4.9%, as the energy sector continues to really benefit from a recovery in valuations through the end of the year, after significant write-downs were suffered sort of early 2020 during the early days of the pandemic. As highlighted, the other portfolios contributed positively for the year, however, just had minimal impact due to their relatively small size. I'll wrap it up here. Again, there's a lot of other information in here, and happy to address any questions you may have.
Thank you once again, Mr. Marcus. Any questions on the real return performance report? All right, hearing none, we're going to move to our investment portion of our meeting, agenda item 3, and I'll turn it over to our investment committee chair, Mr. Lavender, Member Lavender.
Thank you, Madam Chair. Good morning, everybody. I think that one little sideline comment here, I think it's pretty impressive that we've been able to maintain the value of the funds, both funds, in spite of all of the gyrations that are going on in the world right now. And I think that's a perfect example of why we remain diversified and spend so much time trying to make sure that we are diversified in the various areas. And it's just pretty amazing that we've been able to hold our own, hold our own. And my tip of the hat to Vincent and his entire staff, because this is pretty incredible stuff. When you look across the spectrum of other funds and other entities, there's a whole bunch of them haven't done nearly as well. I think that's really cool. We had our investment committee meeting 2 weeks ago. Due to scheduling conflicts and a lot of other difficulties, I happen to be the only member there, so there wasn't a voting quorum on the recommendations. However, each of the following investments were presented, and I was very comfortable with each of them. That's just my opinion, one vote. And so what I'll do is these are coming forward without a recommendation of the committee as far as what the council wants to do. So we'll leave that up to the various managers and various directors to bring it forward. I think that without further ado, let's bring in Keith and Townsend again to talk about EQT Exeter IVF 6.
Madam Chair, I have a question.
Yes, Member Messina.
Thank you. Before we get into a vote, I came across a item from 2019 that appeared to be a legal opinion of just a little over a paragraph. And the thrust of it was that under the Constitution and our statutes, that the role of the council is limited to policy and oversight and not for making investments. And I don't know where that opinion was from, and I wanted to sort of direct this to Ivan to what the legal issues are, or whether we need to look at that.
This is Evan.
Member Messina, this is part of our ongoing discussion, pertaining to the appropriate role of the council, which I don't think we have a complete determination of yet. So I'm not sure if anyone wants to weigh in at this time.
Well, that would be appropriate. But I think it's different if there are legal constraints about what's appropriate that we really haven't addressed totally. I don't know if there are. Confused.
Evan, do you want to respond? I have a response if you'd like, but I wonder if you could respond.
Why don't I try and respond? So first and foremost, the council may look at investments. They have elected to do so, and that is appropriate for them to vote on investments. By way of background, Bruce was asked to look at statutory authority and to give council some recommendations, which the council is free to disregard. It is not necessarily 100% clear cut. And so for purposes of today, I think all I'll say is the council is acting appropriately and has full authority to vote on investments.
Thank you, Evan.
All right, with that, we're going to move to our first investment presentation. We are on agenda item 3B, the vote on EQT Exeter, and I will turn it over to Mr. Sable, and you can introduce folks from Townsend and from the firm if they're with us.
Madam Chair, this is Keith Sable with the real estate investment for today. We're recommending jointly with Townsend a commitment of up to $100 million in EQT Exeter Industrial Value Fund 6. Joining me today for the presentations will be Brian Chen, head of IR for EQT Exeter, and Matt Brodnick, CIO. And then from Townsend, obviously, Seth is on board today. The content for this presentation begins on page 267 of Diligent. Again, to reiterate my opening comment, we're recommending a commitment of up to $100 million in EQT Exeter Industrial Value Fund 6. This first re-up would be SIC's fourth commitment to this series. The fund's target return is expected to fall in the 13 to 14% net, with about 1/3 of that derived from income and the remainder from capital appreciation. Performance of prior vintages has been exceptional. Funds 3 and 4 are nearly completely realized, and we're seeing IRRs there of approximately 30% and net equity multiples on the order of 2.2 times. Each of the Series 5 vintages is in the top quartile in a relevant frequent universe. Exeter's focus is on industrial real estate, where secular growth in e-commerce and the evolution of both the supply chain and consumer preferences has created value add opportunities. The GP seeks to pull three key levers in driving value creation. First is acquiring properties at discounted valuations that reflect addressable exposures to property level specific risk factors. Second is driving property level value creation through disciplined development and redevelopment activity and improved leasing status. And then finally, aggregating assets into diversified high income portfolios that are attractive to buyers with lower cost of capital. GP's success has led to quite rapid growth. This vintage will be about twice the size of prior vintages, and at some level that does present a potential risk factor, largely because it would require the GP to execute on essentially twice the deals that it has in the immediately preceding vintage. We believe that Exeter possesses the financial flexibility, organizational structure, and stable, experienced leadership team to manage that requisite growth. And therefore, after reviewing all the risks and benefits, we're comfortable recommending a $100 million allocation to Exeter Industrial Value 6. That'll wrap up my comments, and I'll hand over at this point to Seth for his color, and then we'll ask the representatives from Exeter to join in with a very brief presentation and to be available for Q&A. Go ahead, Seth.
Thanks, Keith. So once again, this is a follow-on commitment. We started investing with Exeter back in 2014. This would be, as Keith mentioned, our fourth to their U.S. dedicated industrial fund series, where we've previously committed a total of $175 million in commitments. We've also invested in their European industrial fund series, two funds totaling also $175 million. And then back in February, we approved a $100 million commitment to their U.S. Core Plus fund. Each of these funds performed well, and it is why we're here, seeking a follow-on commitment to the value fund. While this may seem like a lot of historical exposure current commitments to one manager, as noted in our memo, it only represents 9.7% of the real estate portfolio, as a reminder, 35% our limit. Further, Exeter has a very strong track record of realizing and distributing back to investors their capital upon a portfolio set exit, really a lump sum exit versus a deal here, selling a deal there. And this specifically occurred in the fourth quarter, where they sold a European portfolio and distributed over $113 million directly to the SIC at an executed sale price or an executed equity multiple of 2.4 times. Before getting into the investment, I do want to highlight, as I have in the past, investment pacing for the year. As previously highlighted, Townsend's investment pacing model for 2022 originally called for about $300 million of new non-core commitments with no additional core. That was targeting our 12% allocation, and again, the 55% core, 45% non-core target weighting over a long term, while also maintaining vintage year diversification. We've updated that model now that we have the year-end data that I just previously presented. And we also looked at a few different scenarios, so using various growth rates alongside that 12% target allocation. Our model calls for in the range of between 360 and 430 million of non-core dollars. So with that said, commitments can be accelerated or decelerated really based on the quality of the opportunity set, the market environment, target weightings. The proposed commitment here will be our sixth commitment of the year, totaling $564 million of non-core real estate. But this is, again, so a really high caliber and existing manager, just like the prior five commitments were previously in this year. We invested across U.S., Europe, and Asia. And this overcommitment is not anticipated to cause any compliance issues or allocation concerns within the real estate portfolio, but may result in reduced commitments going forward as affecting the total allocation. Keith did a great job of sort of outlining the strategy here by Exeter. They are seeking to raise $4 billion for Fund 6, targeting sort of mid-teens return over an 8-year life. As Keith mentioned, we positioned the portfolio to be overweight industrial, given the strong demand fundamentals driven by e-commerce over the past 10 years and really accelerated over the past 2 due to COVID. Our portfolio today has a 34% allocation to industrial. That's down a couple percent versus the prior quarter because of that sale that I just mentioned. However, even after this commitment, that exposure is anticipated to decrease slightly given unfunded commitments elsewhere, really specifically to multifamily investments. So for these reasons, we're recommending this commitment to really maintain our overweight to industrial and not necessarily increase it further. In our memo, the comparative advantages, potential risks are again outlined, but the experience within the industrial sector combined with the platform experience, the strong track record really makes this a compelling opportunity. Exeter's performance is highlighted on page 271 of Diligent, and that's the table that Keith is referring to, showing top quartile performance throughout its history. Further, you can see that with the exception of the most recent Fund 5 that's just wrapped up its investment period, the prior funds are nearly fully realized. So this is not a projected performance, this is actual delivered performance to investors. The other advantages include the platform strength, the experience, and obviously the targeted market opportunity. Of the potential risks outlined in our memo, I spent some time on the platform change back in February when we made our commitment to the Core Plus Fund, so I won't regurgitate that today unless there's any questions. But the one potential risk that I do want to highlight, and Keith mentioned as well, is the fund size. This is a substantial increase from the prior fund. There is some uncertainty at this side that Exeter can continue to really replicate the proven success given the much larger pool of capital. Assuming an average size of property type in the $15 million range, this requires Exeter to really identify over 265 acquisitions. The size has the potential to really challenge a sponsor's ability to do single one-off transactions and maybe forced to acquire larger pools of assets or maybe deploy capital through portfolio acquisition. But with that said, we view the sponsor and the team as being very appropriately resourced within the firm, that they operate at a significant profit and the ability to really hire and retain personnel as needed. From a sourcing and acquisitions perspective, investors are relying on really their decentralized platform, which has grown over the last 15 years and includes investment and leasing professionals across 22 U.S. regional offices, one New Mexico as well, really providing a long and deep established network of relationships that really has that sourcing opportunity. So there's a few additional points that also help reduce the uncertainty in size is the track record. They have no legacy assets that would be sort of problematic, that would take time and attention away from the team. And also that pacing is really in line with the prior funds, which invested back in 2001 and is currently tracking to about 240 potential deals, representing about $3.5 billion of equity historically. So with that said, we buy rated this fund. We have multiple investors that are looking to make commitments. And I'll stop here, hand it over to both Rayanne and Matt to present the fund to you.
Thank you. This is Matt Brodnick. As mentioned, I'm EQT Exeter's Chief Investment Officer for our North American Logistics Real Estate Platform. I've been with Exeter for 14 years, and we've been in existence for over 15, so since near the beginning. And as mentioned, we've invested through our Value and Core Plus Fund series over those 15 years, and not all top quartile, but top ventile performers at realization. Each fund expanding in size over the years, beginning with our first fund, Value Fund 1, at $357 million, through to Fund 5 at $2 billion, and Fund 6 now at over $4 billion in equity. And we're able to invest that, those additional capital because we've grown organically our presence throughout the United States, Mexico, with 24 offices, staffed by investment leasing officers, which are the lifeblood of the organization, property management staff, and construction managers. We're now among the largest and most successful real estate firms in the United States. We've earned our success as a truly vertically integrated real estate operator, and it's an important distinction because we do everything ourselves. I mean, we're a market disruptor in many ways. We do our own leasing, our own management, building, our own development. buying buildings and land locally in small bite sizes over many transactions, creating value through leasing, then aggregating what we bought into large portfolios when it's time to sell. From an investment perspective, the real secret sauce is that we utilize this network of local investment leasing officers who source over 75% of our deals through local brokers, non-solicited direct offers, purchase offers. That field force has grown 30% beginning of fund 5 to now 32 strong, with about 4 or 5 coming on in the next couple of months. We track every building and development site on market. We assemble a massive deal pipeline, typically buying, as I mentioned, 1 or 2 buildings at a time. We don't believe you can powerfully invest in any market unless we're physically located there. Since 2021, our team has invested $2.5 billion in equity, over 150 transactions, effectively completing Fund 5 in almost 4.5. It's a big confidence to raise a larger fund. Though we have the ability to invest a lot in a lot of transactions at one time, we have discipline, especially not to slow down, nimble and patient, especially in this point because we're seeing 10 cap rates. Obviously, with the economic uncertainty that we see with interest rates and all that. We really have 3 section strategies today. We can use our direct leasing skills or abilities as an operator to reposition buildings to make it lease ready, buy short-term lease buildings, so we can use a tenant relationship as our standard renew the building, and finally, so we take land, title it, and build into supply scarcity. Primarily, supply chain building owner, so typically step 5 of a building catering to the largest, highest credit tenants, whether it's a big bulk building, last mile facility, or truck terminal. The real secret sauce for our success in our leasing capability and direct communication with tenants, being to buy the building, EQT are also responsible for leasing them. We don't hire listing brokers. We have many direct and deep global tenant relationships with like the Walmart, Target, Medline, XPO, FedEx, McKesson, and others. By talking to tenants, we know where they want to be and the right buildings to buy. To give you an idea of scale, in 2021, we consummated 400 leases totaling 50 million square feet. Despite what we're seeing in the capital markets, tenant demand is strong. We're on pace in 2022 to either match or exceed our 2021 leasing results. On the development side, we use our in-house construction management team to build the best designed buildings, catering to what our tenants want. This is essential, and in this inflationary supply chain constrained environment, we use our development team to monitor material availability and timing, budget rising costs, and work with our leasing team to confirm that we're developing into market scarcity, as mentioned before. All of this allows us to be nimble with our investment platform, being aggressive or patient, depending on what we're seeing in the markets. So we're excited about this opportunity in front of us and look forward to this opportunity with you all. And I'll turn it over to questions at this point. I hope that was brief enough.
That was good. Thank you very much, Mr. Brodnick. I'm going to go at this time to questions from our council members for our staff or Exeter. Are there questions?
Madam Chair, this is Harold. The concerns I had were pretty much addressed by the size, and with Townsend and Keith being comfortable with this, I'm ready to make a motion if that's appropriate.
Very good. Member Lavender, for a motion.
Based on the recommendation of the Council Investment Committee, consultant to Townsend Group, SIC staff in general, fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to EQT Exeter IVF 6, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Catherine Allen. I second.
All right, so we've got a proper motion and a second motion by Member Lavender, second by Member Allen. Any discussion on that motion? Hearing none, I'll go to Andy for a roll call vote on the motion to approve the investment plan.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
I got a vote.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Okay.
Mr. Jennings,
Yes.
Mr. Lavender,
Yes.
Mr. Rawson,
Yeah, yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Ms. Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion is unanimously approved.
Very good, and we thank the folks from Exeter for being on with us today.
Well, EQT Exeter thanks you all so very much for your partnership. We look forward to keep working for you.
Very good.
Thanks.
Okay, we're going to move on to agenda item 3C, which is a private equity investment into TDR5, and I will turn it over to Mr. Lee, and you can, after you make some introductory comments, introduce folks from Mercer, and then anyone from TDR who's on with us.
Great, thank you, Madam Chair. This is David Lee. I'm joined on the call by Chris Cassidy on the staff, Amy Ridge and Richard Pugmire of Mercer, and Eleanor Chambers, partner and head of investor relations at TDR Capital. I'll make some summary comments and then we'll turn it over to Mercer and then turn it over to TDR. And these materials start on diligent page 329. TDR5 is a mid-market buyout fund. It'll focus on pursuing control positions in mid-market companies, either headquartered in Europe or with substantial operations in Europe, generally with an enterprise value greater than 300 million euros. TDR's strategy is sector agnostic, but will likely target the consumer, leisure, financial services, and business services sectors. The firm's thematic approach to sourcing, opportunistic approach, and ability to embrace complex situations has led to historically acquiring investments at below average entry multiples. TDR5 is a concentrated strategy and will have a target of 7 to 10 companies in the fund, and the investment check sizes will range from 250 million to 750 million euros. The target size of the fund is 4 billion euros, and the general partner commitment is large and will be at least 10%. Fund size for TDR4 was about 3.5 billion euros, and Fund 3 was about 2 billion. TDR's track record is excellent, with 3 out of 4 funds in the first quartile of the Burgess Europe Universe as of 12/31/21, and the only one that wasn't Fund 2 is second quartile in net TVPI. And all 4 funds are above median by DPI or distributions to paid-in capital. TDR's strong performance and excellent reputation have understandably led to oversubscribed funds. Performance has been one of the strongest amongst all of our managers and is attributable to their ability to invest in concentrated portfolios with asymmetrical returns and actually minimal loss ratios. For instance, our commitments to Funds 3 and 4 are currently generating a 36% net IRR and a 2.8 times net multiple. Staff and consultant believe that TDR Capital has been an excellent long-term partner and are recommending a commitment of up to 50 million euros, which is roughly $52.5 million at the current exchange rate, in TDR Fund 5. This would be the SIC's third commitment to TDR Capital. We made a 55 million euro commitment to Fund 3 and a 65 million commitment to Fund 4. That concludes my remarks, and I will turn it over to Amy Ridge of Mercer for more comments.
Thank you, David, and good morning to the council. Mercer's materials on TDR begin on page 335. And as David mentioned, so we're here today this is a real opportunity with a manager we think very highly of that's driven great returns in your portfolio to date. They're focused on the middle market in Europe, And we really like them because they're focused on investing in undermanaged or underinvested companies where they really go in and they build value through operational improvement. David gave a great overview, so I won't go into what he already mentioned. And what I'm going to do is really focus on the key findings that we had during our due diligence. So what we really like about them, they have a very large and stable team, and that includes a really strong operations group, which is important since their strategy, as I just mentioned, is buying companies and driving value through operational improvement. They're also very well aligned with you. So they have a GP commitment. As a reminder, that's the capital that the actual TDR professionals are putting in alongside their limited partners into this fund. And that is actually equal to 10%. This is significantly above the market standard of 2%. So that really shows their alignment with us. They also share the carried interest across a broad portion of the team. Sometimes you'll see it's more heavily concentrated towards the senior portion of the team, but they actually spread it across a large portion. And this really helps to retain talent and incentivize the entire team to drive returns. The other thing, as David mentioned, was their strong performance. So they have 4 funds that span almost 2 decades, which we like this because it demonstrates their ability to invest across different market cycles. And importantly, the 2 most recent funds, which are the ones that you are invested in, they are generating top quartile, first quartile IRRs and multiples. The 2 areas of consideration that we spend a lot of time on is a leadership change. So in 2021, the co-founders have decided to move to different roles that will be less involved. So Mr. Dale, he will be moving to the CIO role, and Mr. Robertson will no longer be involved in the day-to-day operations, but he will remain on the investment committee for this fund. So we do like that while the co-founders are stepping down a bit, both of them will remain involved in this fund. And we also feel like they did a good job with their succession transition. It was really well thought out. They talked, there's a big, strong, 12-person partner senior team that they were able to draw from. And they chose new leaders, Gary Lindsay and Tom Mitchell. They averaged 14 years at the firm. So been there a long time, good cohesion, and will continue to work with the co-founders. So we did get comfortable with that leadership change. And we also like that the ownership has transitioned to the new senior leadership team. So that also helps align this new team leading the firm. So that was the main part that we felt to bring up in our due diligence. And with that, I will now turn it over to Eleanor Chambers, partner and head of investor relations at TDR, and then happy to take any questions.
Hi, Amy. Thank you very much. This is Eleanor Chambers. As Amy said, I'm head of investor relations. I'm a member of the management committee at TDR. I've been here for 7 years, and prior to that, 13 years also in private equity, so 20 years total in private equity. Firstly, I just wanted to thank you for the opportunity to present today. We're very appreciative of the relationship we have with you, which dates back to 2013 when you first invested in one of our funds, which was TDR Capital 3. You're also an investor in our 4th fund, TDR Capital 4. As the team has said, we're now in the process of raising Fund 5 to continue our now 20-year strategy of investing in buyout opportunities across the European market and deliver superior returns to our investors. For each opportunity, we're targeting a return of at least 3 times invested capital, but this is combined with a rigorous focus on downside protection. And in our 20-year history, we have never impaired capital. The target fund size for Fund 5 is 4 billion euros. This is, I think, a relatively modest step up on the 3.5 billion of Fund 4. And the message behind this is one of continuity. We want to keep doing what we have done successfully in the past, nothing different. Fund 4, you've heard about the performance. It's a 2018 vintage fund, currently marked at 2 times on a growth basis, generating a net IRR of 43% to investors. And Fund 3, our 2013 fund, which is very much in harvesting mode, currently marked at 4.2 on a growth basis, 3.5 on a net, and generating a net IRR of 36%. Our strategy takes us, I would say, to the less competed areas of the European market, where we can identify intrinsic or fundamental value which has been overlooked by the wider market, often taking us to assets which have been underinvested or undermanaged for a period, or where the value has been in some way hidden due to extraneous factors. But that is often, frankly, a lack of a supportive shareholder with the vision and capital to drive growth. We take a very hands-on approach to our investments, and we have a relatively small number of portfolio companies. That is very intentional. We think that Fund 5 will be somewhere between 7 and 10 investments. And we want that focused approach so we can drive significant value creation at the portfolio companies, regardless of the wider macro environment. And that's because we identify opportunities for fundamental strategic change or big CapEx programs, M&A-driven growth initiatives, or plain vanilla operational improvement initiatives. Every time we look at an investment, we're looking to at least double the profitability of the business and drive those sort of 3 times plus returns, as I say, regardless of the wider macro environment. Actually, on average, we succeed in tripling the profitability of our business, and that is the principal driver of our returns. There's 2 key things I want to really highlight about the team and the way we operate across our investments. The first has already been mentioned, but it's absolutely critical, I think, and that is that we are the largest investor in our fund and therefore heavily aligned with our fund investors. We've always been at least 10% of the capital. We are likely to be in excess of 15% of the capital in Fund 5. That's in line with Fund 4. And this is a straight cash commitment, which is widely spread across the entire TDR team. This undoubtedly informs our approach to risk, our laser focus on capital protection, but I think it also helps to explain why we prefer the lower volume conviction approach to investing. We only want to do the best deals that we see, where we have real comfort on the capital protection point, and see that we can preserve capital in most conceivable scenarios, but also where we see that clear route to 3 times plus on the upside. The second point I would make is we have a very integrated and operationally intense team of 50 professionals, and we all work from one open plan office in London. We're all bound by our financial commitments to the fund, but also by our belief that combining not just investment acumen, but also operating expertise will help drive better decision-making around our investments. Our operating expertise both comes through operating partners, but also a significant data science team. These skill sets are combined with the investment team across the deal cycle, from early stage origination through due diligence and driving the value creation plans once we own our businesses. As David mentioned, we are strictly speaking sector and geography agnostic. We just want to do the best deals for our strategy wherever they are in Europe. But it is fair to say we tend to be investing in traditional economy businesses, in the consumer services space, business services and financial services space, where we can really identify fundamental value. These businesses usually have strong asset backing, strong market positions, high barriers to entry, and offer strong returns on new capital deployment. Our approach necessarily, I think, takes us away from the traditional private equity auctions, where we neither have the time to build sufficient conviction on the opportunity, nor are they generally easy places to acquire assets at something close to what we would consider fundamental value. Through Funds 3 and 4, we've been able to acquire assets at an average of 8.2 times EBITDA, frankly, in a 10-year period where the market was trading significantly north of that. But it's inevitably a patient approach to deal sourcing, and one where we only need to find 1 or 2 great deals each year. As such, we're still very much on the 4 to 5 year fundraising cycle. The last time we spoke to you in a fundraising context was in 2017. The last thing I wanted to say is that despite the clear macro headwinds that we're facing in all economies at the moment, we believe that the investing environment for our strategy will be very strong in the next 3 years or so. As cost of capital increases and owners of assets seek to focus their operations on their core competencies, we believe there'll be a number of really strong but overlooked companies that will be able to acquire at compelling valuations, and that will form the portfolio of Fund 5 to continue our strategy of delivering very strong upside returns, but combined with that uncompromising focus on capital protection. With that, I'm very happy to take questions. Thank you.
Excellent. Thank you to Ms. Chambers for being here with us today. And we are going to now turn to questions. from our council members for the investment recommendation into TDR 5.
Madam Chair, this is Tim.
Yes, Mr. Treasurer.
Thank you. I just want to compliment them on their ESG and how strong the integration is with their investment process. I found that quite enlightening. So thank you.
Thank you for that.
Thank you, Mr. Treasurer.
Madam Chair, John Bingaman.
Yes, Member Bingaman.
Question actually for David Lee. Just wondering, I think it's a 50 million euro proposed commitment. Do you think we could have gotten a larger allocation in this fund? And going forward, could you sort of track what you think the max allocation we could get into some of these funds is? I think it just sort of goes to the point that the discussion we have once in a while around the ability to deploy more capital into private equity. So just appreciate your thoughts on that.
Sure. Thank you for the question, Member Bingaman. TDR obviously has been one of our best partners. There was a lot of debate between staff and consultants about the size of what we should request. There's a lot of different factors that go into that. I would say that we are all definitely aligned with growing the private equity allocation. And so you shouldn't misconstrue the fact that this isn't a gigantic allocation. But we do have to take into account various things that are maybe not quite as obvious. For instance, successful managers in our program actually have a bit of a burden from a portfolio diversification perspective, because Chris and I are watching that pretty carefully along with Mercer. So if the tendency is to be successful, then what happens is you have sort of an outsized NAV for the size of your previous allocations, and that ends up being sort of an outsized portion of the portfolio. Even though I would add that PDR, as I had mentioned, has been above median in terms of DPI. So they've done a great job at returning capital. But just the fact that their companies have performed well, along with some of our other managers, they have the same problem. We do run into situations where we're trying to make sure that they don't get too high from a diversification perspective. And that's the reason why it ended up being kind of the lower end of the range of the allocations that we were discussing for this fund. But we're obviously, you can tell by our comments, we're very, very happy with them. TDR has done an excellent job for us and for all of their other limited partners. And we're excited about continuing the relationship.
Okay, thanks for those additional comments.
Sure.
Further questions? Are we ready for?
Madam Chair, hearing none. Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to 50 million euro to TDR 5, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Jennings.
All right, we've got a proper motion from Member Lavender, a second from Member Jennings. Any discussion on the motion? Hearing none, I will turn to Andy for a roll call vote on the commitment to TDR Capital 5.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen? Mr. Bingaman?
Yes.
Madam Chair, the motion is unanimously approved.
Thank you, Andy, and thank you to the folks from TDR Capital that were on with us today.
Thank you very much.
All right, next we're going to turn to our last investment vote of the day, and that is agenda item 3D, private equity recommendation into Scale Ventures 8. And once again, Mr. Lee.
Thank you again, Madam Chair. I'm still with Chris, Richard, and Amy of Mercer, and we are now joined by Andy Vitas, partner at Scale Ventures, and Stefan Epperle, General Counsel and Head of Limited Partner Relations at Scale. These materials start on diligent page 373. Scale Venture Partners 8 is a venture capital fund with a focus on early stage technology companies in the enterprise software space. Scale began operating in 2000 under Bank of America, and B of A was the sole investor in funds 1 and 2, and then was spun out of the bank in 2006. For the first two funds, the technology, healthcare, and semiconductor industries were targeted by the team. Fund 3, Scale's first independent commingled fund, was raised in 2009. The industry focus was narrowed to technology and specifically to enterprise software companies. This fund strategy will focus mainly on Series A and Series B investments, and this is primarily in North America. Company investments are usually in the early revenue stage of their life cycle and have demonstrated product market fit. Scale 8 will have a target of 25 to 30 companies in the fund, and investment check sizes will average roughly $30 million. Scale typically takes at least half of the funding round that they participate in and maintains 50% reserves for follow-on investments. The target size of this fund is $800 million, and the hard cap is $100 million, which would include a 2.5% general partner commitment. Fund 7 was $600 million, and Fund 6 was $400 million. Scale's track record is impressive with Funds 3 through 7, and Fund 7 is a newer vintage, 2021. We're all in the top half of the Burgess North America venture capital universe as of 12/31/21 data, and Funds 4 and 6 are in the top quartile by total value to paid in. The performance is particularly impressive for Funds 3 to 6, which was after they narrowed their focus to enterprise software, as net IRRs for the last 4 funds are at least 22%, and net TVPI were at least 2.8 times. The size of the fund and Scale's growing reputation and performance history have led to a strongly oversubscribed situation. The terms reflect their strong investment history, but do include an all contributions first waterfall, which we view as very positive. Staff and consultant believe that Scale Venture Partners is an excellent long-term partner and are recommending a commitment of up to $25 million in Scale Venture Fund 8, and this would be the SIC's second commitment to Scale Venture Partners. The council approved the $25 million commitment to Scale 7, and that was subsequently cut back due to the oversubscribed situation to a $15 million commitment in Fund 7. That concludes my remarks. I will turn it over now to Richard Pugmire of Mercer for further comments.
Thanks, David. Just as a reminder, Scale was one of our venture capital commitments that we first made in 2020, along with Menlo Ventures, as we started building out the venture capital portfolio. We were going for $25 million in 2020, but as David mentioned, due to high demand from investors for Fund 7, we were cut back to $15 million. But the SIC was one of a few new limited partners to get access to the fund. We're recommending a commitment of $25 million to Scale Venture Partners 8. Similar to 2 years ago, there's a lot to like with scale. Regarding the track record, all of the institutional funds that they've done since 2009 are tracking above median, and the more mature funds have generated net IRRs greater than 20%. The 2009 and 2013 funds are top quartile when it comes to capital return to investors, showing their ability to realize investments, which is more important now because markets can be volatile and you want a fund manager who can sell companies. Scale has an experienced team of 7 partners, averaging 14 years at the firm and 23 years of relevant experience. They really focus on internal promotion, with 2 of those principals being promoted to partner for Fund 8, which we feel is a positive for ensuring Scale will be a long-term fund. There was some mid-level turnover that we took a look at, but it appears to be amicable departures. From a strategy standpoint, they have a strong focus on the early revenue stage enterprise software companies. They want companies that have already established a product and have some revenue, which removes some of that risk from investing in a straight startup company. Over time, they've had an increasing focus on adding value and building operational resources, which will be more important in volatile markets where hold periods may get extended. They have a proprietary benchmarking tool that they've developed over the years, and references that we talked to commented on this as a key differentiator of Scale in the market, as they're able to get broad market data, which helps them in making decisions. We did take a look at fund size as well, which is a common consideration that you see in our reports with the high-performing funds. Scale's been able to manage increases in the past, and the increase seems reasonable given the even greater increases of assets under management that we're seeing at some other firms. On the consideration side, some terms are considered premium. We are seeking to bring high-quality managers into the portfolio, and many of these will have a few premium terms. The management fee is slightly higher than average, although they were able to bring that down from the last fund. And it's not as high as we've seen some firms in the venture capital space. There's also now a scale with the carried interest percentage if the funds generate strong performance. However, overall, we feel alignment is above average given the ownership structure they have, the carried interest allocation among team members, and the increase in the minimum general partner commitment for this fund. So overall, we're recommending an up to $25 million commitment to Scale Venture Partners 8. And I'd like to introduce Andy Vitas, who's a partner at Scale, and he's been there for nearly 15 years, and Stefan Everly, who's Scale's general counsel and head of limited partner relations. We'll give a short presentation, and then we're happy to answer any questions the council may have.
Great, thanks for that summary. I'm Andy. As mentioned, I've been with Scale for coming up on 2 decades now. So I want to just thank you for the opportunity to present here. We never take any investment from any of our LPs for granted, and we're looking forward to a long partnership with the state of New Mexico. I'll be fairly brief. As was mentioned, I think a few things stand out about Scale. We've had the 7 partners have all worked together for a long time, and we have a very stable partnership. One of the unspoken truths in venture is that the relationship between the partners is absolutely critical in terms of making great investments. Sorry, was there a question?
Just, can I remind folks to just ensure that you are on mute, if everyone can just double check that?
Yeah. And so you know, a lot of investing at these early stages requires a lot of trust within the team, and that's why we have a strong bias towards mentoring new partners and growing them within the firm. So even our newest partner has been with the firm for 5 years. In terms of the strategy, as covered, it's a very focused strategy. We invest only in business software. All our investments, the product that we're investing in has been in the market for some amount of time, and this is a very differentiated approach for Scale. We're one of the few funds that have taken this approach, which is to invest right after product market fit has been achieved. And this has 2 advantages. One, we think is dramatically lower risk once we can speak to a handful of customers who can tell us, you know, whether the product is meeting their needs. But more importantly, you can still get a large, you know, a high return because the bulk of the company growth is still ahead of it. We make about 25 investments per fund, and part of the reason for this expansion, we've historically come a little bit short, usually landing around 18 to 20. We think we'd like a little bit more diversification and would like to land close to 25 investments per portfolio. Our strategy, we start with the big overarching trends, and then we look for markets that are likely to be disrupted by those trends. Ideally, multiple trends are converging in a single market that allow a new entrant to sort of challenge the old incumbent guard. And so that's what we're looking for. Some of the types of markets we invest in are things like productivity software for business users, security. That's a very common refrain these days, is security in software, and then a lot of data analysis and kind of data operations as more and more companies become driven by the data that they're collecting. And then I'd say going forward for Fund 8, one of the key themes that you should expect to see in this portfolio is the addition of machine learning and artificial intelligence into the products that engineers are building. We think that there've been a few false starts historically over the decades in terms of machine learning, but we believe that this time the trend is here to stay, and about 2/3 of the portfolio will be heavily informed by the addition of machine learning and intelligence into the software. And we believe in the long run, this results in a more productive workforce, as a lot of the drudgery and the grind of being an office work is removed and kind of taken over by machines working alongside humans. In terms of the value proposition, as was covered, we're investing in companies that are typically around $1 billion of revenue, of annualized revenue, and our goal is to get them to 100 and 200 million of revenue and ideally go public. That's the type of company we invest in usually has about 6 or 7 engineers, and maybe one person is helping with the go-to-market. And over the life of our investment, that shifts from an 80% investment in engineering to probably 2/3 of the capital needs go into sales and marketing as the company takes the product to market. So our entire orientation around our value add is to help companies through that scaling phase. As covered, we have a software platform that tracks a lot of those non-GAAP financial metrics. It's certainly the only platform of its kind in the industry. It's been a long 5-year investment to kind of fully realize the potential for this product. And I think it's finally starting to bear fruit, but we still have a lot of the management fees still devoted to investing that over the next 5 to 10 years. And finally, we've built out, given our sort of long existence in the industry, we now have a very large network of alumni from our portfolio executives who we make available to many of our newer portfolio companies to help them just jump more gracefully through some of those hurdles that have been navigated in the past by some of our more mature portfolio companies, and that's been very well received in the industry. So I'll pause there for any questions. But very, very excited about the potential for Fund 8.
Very good. Mr. Vitas, is it?
That's correct.
Okay, thank you very much. We're going to turn now to our council to see if there are questions for either our staff, Mercer, or the representatives from Scale that are on with us today. Okay, hearing no questions, is there a motion?
Madam Chair, based on the recommendations of the Council Investment Committee as consultant, Mercer, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $25 million to Scale Ventures 8, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Catherine Allen. I seconded it. Also on that last vote, I would have voted yes, but I got dropped. I've been dropped several times on the phone call.
Oh, shucks. That's too bad. I'm sorry to hear it, Member Allen, and we'll ensure that we get your vote in there, okay?
Okay, thank you.
All right, so we've got a motion from member Lavender, a second from member Allen. Any discussion on the motion? Hearing none, I'm going to turn it over to Andy for a roll call vote on the $25 million recommendation to Scale Ventures 8.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
No.
Mr. Jennings.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes 8-2.
Very good. Thank you very much, and thank you to the folks from Scale for being on with us today. We're going, that concludes our investment votes. We now have a vote on a manager termination recommendation in agenda item 3E, and I will turn it over to Starla. Are you there?
Yes. Yes. This is Scott from the SIC and Matt Sturgeon from RK are this item. So this memo is on 230K. Recommend terminating Franklin Resources and redistributing their 5% allocation, which is currently approximately $275 billion, to the MSCI Acqui XUS Small Cap Index. This strategy has consistently underperformed the benchmark, and specifically, it has not outperformed in value markets as was expected. There's a memo before you, but those are my brief comments. I'm glad to answer any questions.
Okay. Do we have any questions on this recommendation? Hearing none.
Madam Chair, I'm ready to, I can make a motion here. I think it's important that we, I think it's just as important that we really carefully take a look at investments like this and terminate them when they're not working. So based on the recommendation of the Council Investment Committee, consultant RVK, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve the termination of manager Franklin Resources Templeton International Platform, and that assets be redistributed to Alliance Bernstein, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
Okay, we've got a motion from member Lavender, a second from member Tejas. Any discussion on the motion? Andy, would you take a roll call vote on the motion to terminate Franklin Resources?
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes. Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion is unanimously approved.
Very good. Now we'll move on to agenda item 3F.
Madam Chair, Madam Chair, if I could just interject, I'm sorry, in this particular section.
Yes.
I just wondered, because we have David and Chris on the line and Mercer, I just wanted to get have a little, maybe a little fill in on where we are with our New Mexico private equity investment program. The fact that we haven't seen a lot of investments in that particular program recently, And I just thought I'd like to ask what's on the table and where do we stand with potential future investments. We've got a couple of months here. We're not going to be together. And I'd kind of just like to have that information if I could, please. I'm throwing this at you, but I know you can handle it.
Sure. Hi, Mr. Lavin. Go ahead, Mr. Dip, sir. I was going to say. Yeah, we're. Go ahead. Yeah. We targeted more, Member Lavender, the back half of the year. That was based on the capacity to be able to, and the fact that the first half of the year was obviously pretty heavily based on national program. As a matter of fact, I think, if I'm not mistaken, I think that was our busiest first 6 months in the national program, at least in terms of bringing managers and funds in the history of the program. So, but we have been targeting certain managers, mostly re-ups with a couple of potential new. We've been taking a lot of meetings. Chris, if you want to give more detail, or if Richard wants to give more detail, that would be great.
We're starting due diligence as it were today, or right now, effectively on a group that is really quite interesting. It could be a great fit for the program, and we're continuing to speak to a number of groups about their interest in the program and whether or not they can realistically make a new investment in New Mexico, and most importantly, that investment be impactful, because that's really, at the end of the day, this program what we care about. We want to see companies being built and scaled that are ultimately successful, and managers that can help them along the way with both capital and other types of expertise to help companies. So quite excited about the one I'm mentioning. I don't know the exact timing on that, but it'll be most likely over one of the next two meetings.
Yeah, Richard. Member Lavender, I'll add two things, have been going on with the fundraise market. One, with the slowdown in the first part of the year, some of the funds that we've been tracking that were expected to come out in the mid to latter part of the year have been pushed to the next year, but we're still tracking those. We do a forward calendar process where we discuss every 2 weeks and really discuss all funds both in the market and that are expected to come to the market. And we're excited about some that are coming, and we don't want to compromise and do a fund that doesn't have as high of a potential for New Mexico economic opportunity if there's a better one coming in the upcoming months. The second thing is we do find there's a number of fund managers willing to talk about investing in New Mexico, but we want to see proof before we bring it in front of the council for approval. And sometimes that takes time to see how are they going to interact with the market, how many companies are they going to meet with. And this one that Chris mentioned is a great case study of that, where we really saw them actively visit the state of New Mexico, talk to a lot of different entrepreneurs out in the market and be more active, which gave us more comfort with moving it forward in the investment process.
I appreciate those comments. Now that we're finally going out amongst the public more, I have a number of opportunities to be around folks, and I'm getting importuned on a consistent basis about these kinds of investments. So I appreciate the fact that response, and appreciate the fact that we're moving forward with trying to make sure that we get more investment in New Mexico. So thanks. Thank you, Madam Chair.
Absolutely. I think it's something that we all care about, so it's great to hear an update. I'm going to turn now to agenda item 3F and turn it over to Mr. Smith for SIC portfolio composition analysis.
Thanks, Madam Chair. I'll be very brief here. As you know, we continually look to upgrade our systems and our ability to analyze the portfolio, in terms of exposures and weights and so forth. We've got new resources as of the last couple of years to do that. One of the point people on our staff to do that kind of analysis is Nino Carpenito, and I want to reintroduce him to you all. You haven't heard from him in a while. And Nino put this report together. Steve took a look at it and thought it might be of interest to the council. So let me turn to Nino for a little bit of comments on his report, and then he and I both will take any questions that the council might have.
Thanks, Vince. So because of the lag in reporting of private markets, when we provide updates internally on things such as performance and exposures, we'll specify this is with X number of X fund reporting. The question came up, well, how many fund investments do we have, across asset classes in both public and private markets? So we put together this analysis and wanted to share it with the council. So as you can see, we have 342 total fund investments.
Nino,
20. Yes.
Can I just interrupt and let folks know we're on page 431 of diligent?
Thank you. So again, in total, we have 342 fund investments. 25 of those are in public markets, and those are structured predominantly as separately managed accounts. Within private markets, we have 317 fund investments. 217 of those are current, and 100 of those are legacy. We would define legacy as, those are investments that were made under a previous administration that remain on our books. In terms of asset classes, those legacy investments are within private debt, primarily within private debt and private equity. On the private debt side, that's where our legacy hedge fund portfolio resides. And then in private equity, you'll see those are primarily in the national program, although there are still quite a few in the regional program. Something to note here is with the legacy investments, while they constitute a large percentage of our total funds at 30%, in terms of net asset value, they represent just over 1% of the portfolio. Those are all the comments that I have, unless anyone has any questions for Vince or I.
Madam Chair, John Bingaman.
Yes, Member Bingaman.
Just a question. There was a reference to legacy hedge fund investments. I guess I was surprised to hear that because, I thought you could, withdraw your money from hedge funds and sort of get out of those on a relatively liquid basis. Is there any additional information you could provide? I guess I just didn't know we still had any hedge fund investments.
Yeah, Member Bingaman and Spence. So there's two things going on with those. Number one, some of those assets are ones that I think more or less are stranded. Either we can't sell them, there's no liquidity, they're locked into a structure that we can't liquidate them. The second thing is there were a few, very few, that we just didn't have the best contract terms, and some of them are locked up for periods that we might have gotten shorter periods with better contracts when those were done. So it's a combination of those two things, and we're hoping the books will clear at some point.
So this is a fascinating table. I guess I never could have said off the top of my head how many funds were invested in. This is really great stuff. What year are we talking about in terms of the legacy investments?
Those would primarily be before 2011.
Okay. Thanks. I very much appreciate you all putting this together and sharing it with us. discussion from council? All right, hearing none, we're going to go to our CFO, Mr. Shipp, for his report, agenda item 4A.
Madam Chair, I'm on page number 433 of the diligent material. Just one item on that page that I wanted to point out, number 3. We are currently in the process of finalizing the agreed upon procedures report for fiscal year 22 third quarter. I should say, I think I said we. Moss Adams is in the process of finalizing that. I've looked at a draft. We will be sending out that report likely on Thursday, which is the 30th. So everybody should be expecting that. And then if everybody could flip over just a couple of pages, page 435. I just did this schedule, and I wanted to make sure everybody recognized under column C, and this is the summary for our fiscal year budget, and this is for the 11 months ending at the end of May. I just wanted to point out that our bar for $4 million, I think I had mentioned that in several of the past meetings that we were requesting a bar that was approved, and it has been reflected on the schedule. So we hopefully, as far as the year-end process is concerned, we're still adjusting some POs and paying some other bills. We'll make it through the end of the fiscal year without any budget challenges, especially given the fact that we have that bar. And then if everybody could just turn over to page 477. I did want to point out just a few things on this schedule. I think Andy mentioned the inflow from the land office for this month was over $200 million. I think this is the largest inflow that we've had to date. And then I did want to point out under bullet item number 3 that we did in May receive some tailored raising proceeds of about $123,000. This is very consistent with what we've received in prior years. And then I constantly get asked about fees and allocation of fees. The investment holdings report at the end of May does reflect the fee accrual for the third quarter. And you might say, well, why is it recorded in May if it's for the third quarter? We wait until we get all the invoices in from the investment managers before that accrual is actually reflected, thus the delay. And then I think we maybe mentioned this last time. We did get a $10 million contribution to the Rural Libraries Endowment Fund. And I think that transpired as the result of the special session that we had this last time. And then other than that, I just wanted to, if there's no questions, I wanted to let everybody know we are approaching the end of the fiscal year, just a couple more days. We do keep our books open going into August for payment of expenses. If anybody on the council has outstanding expense reports that are due, I would just ask you if you could get those in as quickly as possible so we can get those processed. After a certain point in time, if we haven't paid them, they become problematic. And I'm just trying to avoid that. And I certainly don't want to have a finding as a result of not paying things on a timely basis. And then lastly, I wanted to emphasize to everyone, because it does get a little tricky starting in a couple of weeks. We are rolling off fiscal year 22 as we close our books and the numbers will be audited. We'll be rolling on fiscal year 23. So our next meeting is in August. So you'll be seeing some information for the new fiscal year. And then also within August, we'll be working on and submitting information on the appropriation request for fiscal year 24. And other than that, Madam Chair, that's all I had unless there's questions.
Mr. Schiff, thank you very much. What exactly is the Taylor grazing proceeds?
You know what, we get that, we get that annually, and, you know, Madam Chair, I can provide more information on that, probably, unless Charlie has something he wants to add. It is money relating to some grazing permits, I believe, that we get in, it's not usually monthly, but annually. That's all I can give you at this point in time, unless Charlie maybe has additional information he might want to provide.
Sorry, Brent, your lifeline is not going to work this time out. We'll research it.
All right. Oh,
all right.
5-9.
Okay.
Taylor Grazing Act is the Taylor Grazing Act it's the same old Taylor Grazing Act. It's one that's paid for use for grazing on state lands. It's my understanding. That's always what I thought it was. State land.
Yeah, that's exactly right from what I recall. But
state land go to our land maintenance fund. They don't go to you all. So I'm curious why these.
Maybe it's for improvements or something. I don't know, but the Taylor Grazing Act. We used to. People have state lands. That's where that money goes. I thought it was the Taylor Grazing Act. That's what they called it.
Let's learn more. Do you know?
Land Commissioner, I'm happy to. Yeah, I'm happy to research it and come back next meeting and provide you more details.
Yeah, could also give me. I don't know if you've got like historic, amount. Is this a typical amount? Do you know?
It is a typical amount. It generally, probably for the last 5 years, it's been fairly close to this, so it doesn't vary all that much. It's just something that usually comes in the May or June timeframe, and I'll research it a little bit more, and I'll provide you more detail next meeting.
All right. Any other questions for Mr. Schiff?
One thing when everybody talks about the income from the from the land office that comes into this, when you look at our oil and gas income, you really need to look those marginal wells, those stripper wells that are out there provide for 20% of the oil and gas income. I believe that number's right, and it just scares me when we've kept a lot of those wells going, because once you plug them, it's gone. But at $100 oil, that really is a lot of money. And I hope, the cost to get that oil out are very high, and we put the thing in there. If you have $200,000 in gross income from it, then you're a small producer. Well, the income cost real life, so gross income is it should have been net income if they wanted to be fair, but that's 20% of our income, and it amounts to a lot of money. I hope people will start looking at that a little bit more about keeping it going, because for years in the legislature we took care of keeping those little wells going, and I understand you got to plug them when they're done, but. And that's fine, but it's a lot of money. Just look about our income, where it's coming from, so we can keep it coming. Thank you.
Madam Chair, this is Catherine Allen. I have a question about this.
Yes, Member Allen.
Yeah. Okay. In what way, if any, have the fires, in particular this latest huge fire that we've had, impacted the State Investment Council, or monies coming from anywhere that would impact us, or monies that may be coming from the federal government?
Is that for Mr. Schiff or Mr. Woolman, maybe?
Well, I'm asking either Steve or whoever staff that might know. Is there any impact? There may be no impact, but I'm asking if there is any impact either in lesser revenues or some way revenues that come from the state, from the federal government?
Yeah, directly resulted. But we'll look into it and we'll get back to you with an answer.
Thank you.
Madam Chair, I wonder, I did have another question. I would like to ask Charlie to maybe expand a little bit on what was in his weekly missive on Friday about the $700 million going into the severance tax fund. You know, we, over the course of the last several years, we've had the whole time I've been on the council, we've had a number of conversations about how fragile the future of the severance tax fund is based on the outflows versus inflows. And I'm just curious, Charlie could talk a little bit about the $700 million, because that, I mean, I can remember being absolutely astounded one year when I believe the inflow was $100. I thought that Charlie had made a mistake in his, left off some zeros. And I wonder if you could talk about that a little, Charlie.
Sure. Mr. Lavender, Madam Chair. So twice a year, the state will issue severance tax bonds to help pay. It's essentially bond maintenance for capital expenditures, and whatever they don't spend using what's in the severance tax bonding fund flows into the severance tax permanent fund. And that we invest it and distribute 4.7% on the 5-year rolling average every year. For many years in the mid-2000s and even into the early teens, we received very little relative to the hundreds of millions of dollars in severance taxes collected by the state. So one year, one fiscal year, I believe the amount was $38. So that is obviously reversed. There were a couple things that triggered that. One was a piece of legislation that was passed in 2019 that guarantees a floor distribution of $28 million a year, I believe, to the FTPF. And so that helps offset our distributions that go out, which are more than $200 million, about $250 million out of the severance tax fund to the general fund every year. This year, there is an excess because of the year-over-year growth in revenues. The legislation that the council supported back in 2014 and passed, the excess year-over-year flows to the severance tax fund instead of being used for bonding. So we're going to get a big lump payment this year, and subsequently in future years, the projections are also pretty healthy. Not anywhere near $700 million. But we'll get a final number for you after the bonds are issued later this week by the Board of Finance.
I appreciate that. I wonder, I can remember Matthias and Marcia talking to us fairly extensively about the long-term prospects of the severance tax fund and the fact that I think it was 50 years the severance tax fund could be at the rate that was happening several years ago would be depleted. And I would like to request that at an appropriate time that maybe another study be taken a look at relative to these current numbers and maybe see if there's a little bit of a change in that. So I appreciate that, Madam Chair.
Madam Chair, real quick, this is Nick.
Yep. Member Tim.
Yeah. Speaking to what Charlie was just talking about on the bonding fund kind of overflowing into the severance tax fund, I was just curious as to whether or not those same kind of mechanics are going to happen with the early childhood education fund. Is that something that we're going to see with sort of these large increases in revenues that are coming into the permanent funds? I think I saw in the minutes where we were going to expect $1 billion of funds to flow into the early childhood fund. Is that all right?
You're correct. We are expecting inflows of several hundred million, if not more than $1 billion, to those funds
in the coming years. I can try to be more precise and follow up with you. But yes, we're seeing a lot of money, just like we see $200 million a month from the land office right now. We're seeing similar effects across our portfolios.
Great, thank you for that.
All right, I think we've almost sort of slipped into our older new business agenda item a little bit, but if there's no final questions for our CFO, we will move to agenda item 5A. Any old or new business before the council? I just want to remind everyone that we don't have a meeting in July. We have a recess for July, so our next meeting is going to be Tuesday, August 23rd. We are seeing about possibly meeting again in person in the cabinet room for our August meeting, so we will keep folks apprised of that. And with that, I'm going to move to public comment and ask Mr. Woolman if there is public comment to be read before the council.
Madam Chair, not today.
Okay, with that, I will take a motion to adjourn.
This is Harold, so move.
Any objection to a motion to adjourn? All right, thanks, folks. We are adjourned.
Thank you, everybody. We'll see you. Bye.